what else but TCS to begin the conversation with, Rahul? I mean, what's your sense? You've initiated fairly recently, right, on
No, actually,
TCS?
I was overhearing your conversation,
Right.
and I'd like to sort of take a little bit of credit for, I think, Girish Pai, of Head of Research, probably had the first sell call on IT on the street. In India on digitization and automation 3.5 years back. We track our competitors very closely. I can tell you the next report that came close to it was a year later. So I think that was the lead that we had above some of our competitors, notwithstanding the quality of the reports you were discussing. But that being said, I think the call has gone so right for us that we decided to take a fresh look. And since you brought up Accenture in your comments, we actually put out a report about 2 years back called Accenture, the Secret Sauce, and why it succeeds. And why Indian IT companies will struggle to gain market share compared to what Accenture is doing. Because the return ratios of Accenture were so high that they didn't mind sacrificing, bringing it down to 100% to gain the capabilities that they did. The problem with Indian IT companies has been that these had legacy. If you go back 5-6 years back, these were 70% ROIC companies. These are all sub 40 now. So I think the point we made then was that Indian companies may not be able to adapt that quickly to digitization and automation. Costs were going to go up, and there were not perhaps that many levers that they had on productivity through utilization levels. In fact, just on TCS, though we've upgraded the entire sector from a sell to a neutral, that is not so much to do with the dramatic changing fundamentals of the sector. One of the key reasons we did it is the largest sector in the country, which is banking, will probably go through its share of pain. And the level, extent of underweight that people had on IT vis-a-vis the overweight, it was, yes. So if you look at the title of our report, it says it's a tactical upgrade that we have done. But within that...
Did you do it late last year, this year?
No, actually we were late on this call, so I'm happy to admit that as well. More than happy to... but I think the pecking order that we have in IT right now is TCS. The second would be HCL Tech.
TCS, HCL.
Yeah, third would probably be Wipro. Fourth would be Infosys, and fifth would be TechM in the large ones.
But do you cover mid-caps as well?
Yes, we do, but you'd be surprised that we have a fairly large downside on Persistent and Mindtree and the likes. Our own view is that Infosys will disappoint on its guidance given. So we were working with 5 to 7%. They came in at 6 to 8. We think that number at the end of the year will be closer to 4.5%, 5%. So analysts will downgrade as the year goes on. But TCS, on the other hand, will actually see upgrades because we're seeing market share gains. So we're not talking about a double-digit growth for any of the IT companies. TCS is anyway trading at a valuation premium to Infosys at 17 times FY20. Infosys must be closer to about 14.5, 15 times. But if any company will come close to a double-digit growth, probably touching 10%, it'll probably be TCS. A large part of our call on growth, Prashant, also is predicated on my economist view on the rupee, which is expecting to depreciate quite substantially as we go into FY20. The call is more towards 70. So I think those will be a few tailwinds that you'll get. But then again, you're not paying it for the core business growth that you see. Obviously, the stocks will find support because of the capital allocation policies that both Infosys and TCS have announced. And subsequently, I think the rest of them will also do it.
Rahul, just a point. Is it still all positioning and tactical?
I believe so. Because I think...
Prashant, underlying, nothing really has...
Absolutely. So what are you paying for? You're either paying for top-line growth, margin expansion, or bottom-line growth. If my top-line growth is going to be, say between 5 and 10%, depending on which company you pick up, if costs are going to rise for me because I have to make investments in automation and digitization, you've seen the rate of growth of the digital platform of Indian IT companies. It's quite phenomenal. So, and employee utilization levels, ex-trainees are very high. So if you're not going to get that double-digit growth, in the top line, if you're going to, exactly. I'd rather look at a company that will probably test me for a little bit of time but will have a higher delta. Case in point being pharmaceuticals, because the valuations are very similar in pharma to IT. But I'd be rather more comfortable putting in money into pharma than IT at this point in time.
Okay, there's news at the bottom of the screen, Surabhi. This is Capital First. I think they'd lent some money to India Bulls, real estate, and they've acquired, basically they've taken
some of the pledged shares, so they've got the 6% equity in the company. That's interesting. Okay, from ID, I'm going to move to a sector that we always discuss with you, Rahul, and that is obviously consumption. Within that, as we were just discussing in the break, obviously the street has been crowding this trade a lot over the last, 2 odd weeks specifically. Stocks are at, sky-high valuations. You seem to be turning cautious now.
Yes, we are. It's more of a valuation call. And Prashant may recall, I was here when we initiated on our foods report, and Nestle and Britannia. Nestle is at a new 52-week high. It's gone up 20% post-initiation. So it's difficult to start.
Jubilant as well, right? I mean,
yeah, Jubilant is at a fresh 52-week high as well. I think Jubilant Foodworks, Prashant, is probably in the last leg of its bull run, according to me. I don't think you'll probably get another 300, 400, 500 rupees at best. And I think the stock could be very quiet for a couple of years after that. So if you've made money, it's a good time to start booking profit. You'll see probably one last round of upgrades post this quarter's earnings, but I think from there on, the base effect kicks in, and I don't think you'll see the kind of numbers that you have been seeing. But on the rest of them, we've turned a bit cautious, citing valuations. One trade that we're still advocating to clients is lighten down on ITC and still add on Hindustan Unilever. To a normal viewer, they may think I've lost my mind because probably one stock is trading at its 52-week low and the other is trading at its 52-week high. But, you know, in our report, we've actually highlighted that this thesis of price elasticity or that ITC claims to enjoy is actually not the case, because if you look at the WHO survey that was done in 2009-10 and the one that was done in 2017 in association with the government of India actually shows that there's been a 20% drop in the cigarette consuming population in India. This is a factual government global data. So the underlying consumer is itself shrinking quite rapidly, which is testing our thesis on the pricing power that ITC actually enjoys. Add to that taxation and the profitability
but
of
it's, you know, to be sure, it's not really pricing, right? I mean, nobody quits smoking because it costs you 15 bucks a stick.
You'd be surprised, Prashant.
Volumes, I mean, we've seen ITC go through the pain.
I would say, I don't know a single person. I know many people who, I think all of us know, but I don't know a single person who's quit because it's too expensive to smoke. Now they quit because of health reasons, right? I mean, they don't want to.
It also depends on the kind of people you're talking about,
right? But I've never sort of heard anyone say that I don't want to spend this much money a month to buy these many packets of cigarettes.
Oh, you're talking to people who probably don't have price sensitivity. There would be, I'm guessing, a different class of, you know,
I don't
smoke consumers or cigarette consumers.
Go on, Rahul. Sorry.
The reasons could be pricing. It could be health.
You're right.
I'm not debating
20% drop.
But there is a 20% drop. So what I'm trying to say is that your core consumer base is eroding, whether you like it or not. And this is not a data point that ITC will come and share with you in public, and they're not probably supposed to in their best interest.
Okay.
But the fact that the profitability of the non-FMCG side hasn't kicked up as well, and we're still seeing another 300 basis point margin expansion in something like a Hindustan Unilever, which will give me an 18-20% profit growth. So our expectations between FY 18 and 20 for ITC on sales, EBITDA and PAT is somewhere between a 7 to 9% growth on all three metrics. I don't know why I want to be paying 27 times even for that. So it goes back to the same point on IT. There actually may be some IT companies that will grow faster than ITC over the next 2 to 3 years. So I'm still telling people that there is growth in HUL. It's probably a better place to be than in ITC.
So I quickly want to try and squeeze in this question in the last 30 seconds, Rahul. You have a buy on Inox Leisure.
Yes, we do.
That's a company that's announced a deal today. They're buying more IMAX theaters, putting up, you know, more of these screens, perhaps across Mumbai as well. Where's the conviction on Inox coming from? So
I'll just quickly give you 3 or 4 points. One is this is as much a real estate business as it is an entertainment business. PVR has captured North India. Inox has captured South Bombay, which are probably the two most lucrative markets. Now, the point is, the reason we're so bullish on Inox is that if you look at the food and beverage side of PVR and the advertising revenues of PVR and the margins they enjoy were far superior than they were in Inox. And if you see the last 9 months, even if you strip out Bahubali, which is probably a once-in-a-many-year movie, the ad revenues have grown 35-40% for them, which is a 65-70% gross margin business. Sorry, the ads are about 90-95% gross margin, and the F&B, which is a 65-70% gross margin business, has also grown much faster than the box office revenue. So I think there's a huge margin delta there. There is a significant valuation gap that you have between Inox and PVR. I've seen, you know, whether you look at a V-Guard and a Havells, an IFB or a Whirlpool, I have evidences to suggest that valuations can converge if you do well. And I think this could be a good play. Content is the only variable, but I think even X-content, there are other levers that are driving the business. The last point is Insignia and the premiumization, which is working very well for them.
Which is right.
Well, actually, they're in all their theaters, Prashant. They have 1 or 2 screens in pretty much most of their metro.
I've been trying to catch a movie, not getting a break.
We'll take one right now, I guess. At least you can't go for a movie in the meantime, but we can take that break. Thanks, Rahul, very much. We'll come back on the other side and get you an analysis on how Reliance Jio is perhaps going to impact telecom sector earnings this time around when they report numbers next week.
कृपया ध्यान दीजिए विमान में अब सुरक्षा संबंधी जानकारी